A very good evening, everyone. Welcome to Admiral Markets webinar. Nanette and myself, Chris, are going to take a look at intermarket correlations and why they're important for trading and financial market analysis. So before we take a look at correlations, be aware of these two basically disclaimers. First of all, explaining the fact that this webinar recording is shown to a global audience but may not be suitable for everyone. Please take a look at admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity for more details and information. Also, please be aware that trading for exchange or global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. By continuing watching this webinar recording, you agree with this disclaimer and you are aware of the risk involved when trading. All right, thank you so much for your attention on that. So the webinar, just a small introduction about Admiral Markets, is basically the host of this. Together with Nanette and myself, we're basically doing a lot of analysis, of course, and content with Admiral Markets. Take a look at admiralmarkets.com for also some interesting options regarding trading, MetaTrader 4 Supreme Edition, and WebTrader. All right, correlation basics. I'm going to talk a bit about basically why correlations happen, what patterns basically are behind those correlations. We're going to be diving into some charts, and then Nanette is going to specifically focus and zoom into certain correlations that we see the last few years, maybe even the last few decades. So that's Nanette will take over in the second part. First of all, what is correlations? Well, basically, it's kind of a statistical interconnection between two assets, so that two assets are showing the same pattern or the exact opposite pattern. All right. Basically, the level of correlation is indicated by a number, either +1 or -1 or something in between. So it can range from anything like a -0.5, or it could be -0.5. It could be +0.3 or even 0. All right. So +1 is the boundary, -1 is the max, the minimum and the maximum. All right. Now, what would those numbers mean? Basically, +1 is perfect correlation, -1 is perfect opposite or negative correlation, +1 would be perfect positive correlation. But sometimes, of course, or most of the time perhaps, the levels are in between. So if there's 0, there's no correlation at all. Anything between +0.3 and -0.3, so like a +0.1, that's just a wee little bit of correlation. And that's something we shouldn't be too worried about, or we shouldn't consider too much. It's not that important. The correlation is very minor, so it's not something we want to factor in. If it's 0.5, then it starts to become more important, and especially if it's 0.7, then we get into a high correlation kind of value. And then it's something you definitely want to consider or think about when you're looking at trading something. For instance, if you're trading the pound and you see the euro dollar is highly correlated with the pound, you might not want to take that trade because the correlation is so high, you're basically taking roughly the same trade. All right, now these correlations change. They change depending on the time frame we look. They change as time progresses, and they're not constant. So for the moment, the euro pound might be, they might be correlated on a daily chart, but if you look at the hourly chart, there could be very little similarity at this point. And on the long run, things can change too. For instance, let's say Aussie and gold. They tend to be correlated, but at one point they could break down and the correlation might just stop for a few years, or who knows, even longer. These are dynamics that are changed and are replaced, but they can last for a while. So we should be aware of that. We should note it. We should use it when it lasts, but also be on guard that it can change and not say, let's say, stick to it forever. And ignore evidence if we see that correlations are changing. Now, the reason why correlations exist is simply because at that point in time, the economic and market environments are aligned. All right, so now that doesn't have to stay that way, right? For instance, the demand for oil um, was pushing oil prices up uh, 5 years ago. Back at 2008, oil prices were 2007 were going up a lot, and at that time maybe other commodities were going up. They were correlated at that point, right? At this point, some commodities might be less under pressure than oil. Gold, for instance, was rising quite a lot relatively compared to oil, perhaps, and they're these correlations could change. That's the whole point, basically. All right. Now, Amra, I think that Nennet might have some ideas. I'm not sure. We can ask him when he's has his part later on. Okay. So this is how a table of correlations could look like. Blue indicating strong positive, dark red indicating strong negative correlations. White indicating neutral, um, no correlation at all, and of course the lighter shades indicating some correlations. And these are a various range of financial instruments from S&P 500 at the top to ethanol at the bottom and other commodities like copper, palladium, gold, and also some currencies like Canadian dollar, euro, British pound. And you can see how they're correlated. So, for instance, if we look at S&P 500, very high correlation with the Dow. Not so surprising. All right, and if we move on, take a look, for instance, at the euro. There's not much correlation there, minus 0.16. Australian dollar, a bit more. All right, so that's how basically things kind of develop at this point. I'm not sure if it's this point actually, but this is an example of 1 year correlation of a whole range of financial markets. Now let's dive into a bit before we show some ways how you can actually use and measure and look at the correlations. First, a bit, why do they actually exist? Now, the market, all of these financial instruments are going basically through cycles. The cycles are dependent on the psychology of the market, factors of supply and demand, economic developments. There are all kind of things that we can look for, but basically, the markets, they all make these cycles, and at some point these cycles are aligned, and then they break down and they're not aligned anymore. That's just how things go. We had a great bull market on the commodities, for instance, so we had a recovery and expansion. And any other market, any other financial market that was also expanding, there would be a correlation at that point in time. That's just very simple why we have those correlations and why we have the same kind of development at a particular time. Now there could be, of course, something behind it that is pushing both of them to expand and to have that cycle. All right, and that's of course why we have fundamental analysis. That's why it's good to look at sometimes why as well and understand what could be the factor behind it. And if we know that factor, then we might understand when that correlation could break down. If you're more into technicals, then simply looking at price and simply overlapping price, or keeping an eye on a correlation table like that, and keeping an eye on the average, for instance, could be enough, right? So it depends if you're fundamentally or more technically oriented. All right, so here you can, for instance, see how certain stocks could show correlations at certain times when the market is or the economy is expanding, right? You will see, for instance, that the stock market is strong, so you see more or less a correlation between some stocks. They're going up with commodities, for instance, right? And you'll see a negative correlation maybe with bonds, or maybe even a neutral with bonds, for instance. When we have a economic decline, we'll see other correlations perhaps arise, right? You might see, for instance, confidence slowing down and that impacting bond yields, for instance, right? So this is just like the typical economic cycle that you would find if you just Google that. economic cycle, and you'll find a lot of info on that. And then you'll understand why certain stocks, certain even groups of stocks, are actually kind of moving along together. For instance, if you are in economic downturn, defensive stocks like the banking industry or a food, for instance, typically would fare better than maybe more aggressive stocks. All right, so the food stocks will also be correlated basically, and together, first of all, the stocks together, but they could also be correlated with, let's take a look here with, let's take a look here. Well, for instance, oil stocks, right? They could do worse. They would be correlated with the commodities as they start to fall, for instance, right? So that could be an example of a correlation as well. All right, so here's an example of such, odd USD and gold moving more or less together. Odd is the price action. Gold is the thin line here, the basically not the dotted line, but the light gray line here that I'm following. So you can see more or less pretty much correlated on this monthly chart in the last 6 years, as you can see, from 2015 to 2009, more or less going the same. Now, a lot has to do also with psychology. There are some factors, of course, for instance, the economic cycle that we just showed, but there's also the market psychology, the market cycle that is pushing these cycles as well. So you have the investors and their kind of attitude towards the market that is certainly impacting the movement of price as well, besides the economic cycle. Now, the market cycle is very much influenced by psychology, and that is very much explained by Elliott wave. Wave theory, by default, is looking at waves, is by default looking and explaining cycles by labeling them. So by doing Elliott wave, you could have an idea as well when cycles can break down. For instance, if price is making a 1, 2, and started to aggressively climb like this, and started to break resistance levels like that, and you see that happening on 2 or 3 instruments, then those instruments, they could be aligned and correlated for quite a while. A wave 3 can push quite far, and that correlation can last also for a large distance. Another example could be, for instance, if 2 or 3 financial instruments are in a wave 4 and they're correcting like this. Well, that can last long too, obviously, because the correction typically takes long, a wave 4, right? So that's when the correlation could stay stable. But it could break down if wave 5 starts. One financial instrument could have an expansion, the other one might have a push and then fail. And that's when the breakdown, basically the correlation could stop, could be less relevant. And we see one financial instrument pushing a lot further and the other one actually showing weakness. And there would be a huge gap, in fact. So wave analysis could, be very important in understanding the mentality, the market psychology of the moment, and understanding if the correlation is still looking strong for the near future or if it's could be breaking down. Now, a bit about cycles and waves. Basically, you have impulses of 1, 2, 3, 4, 5 and corrections in ABC. So that is how you label those cycles in its basic form. I'm not going to dive into any other rules here and guidelines. We got webinars, separate webinars on that. I encourage you to look at those instead. But that's the basic patterns. So when you look at impulse and correction, that's how you'll be labeling them and trying to understand where price is at this point, how it has behaved in the past, and what the most likely next wave is, what most likely next step would be when basically looking at the story of those waves. So for instance, we see a wave 3 here, green. We see ABC correction, And as we see perhaps a continuation of that after the wave 4 is completed. All right, so what would be, considering this start or this history till now, what would be the next likely move on the euro dollar, right? Well, bullish, right? And either a fifth wave or maybe even an extended fifth wave. And it turned out to be an extended fifth wave. And when we get a wave 1, 2, 3 here, 4, 5, and we see multiple divergence, what will be most likely the next move? Well, a bearish reversal, indicating perhaps a turnaround of momentum because we're seeing a fifth of the fifth wave. So this is how you can kind of estimate what might be the next logical step within the sequences that we've seen so far. Now, I'm sure we'll talk about this as well, but some pairs tend to be very strongly correlated. Euro dollar, pound dollar is an example of that. All right, I'm just giving you an example because now that is going to dive into this, a bit more deeper and give more examples. But despite the strong correlation, we do see a substantial difference in 2011, for instance, right? Here we see the pound falling a lot further than the euro dollar, actually. So there was a large discrepancy, a large gap in those two for a short while. All right, and that's why you have to be careful. Correlations are strong, can last long, but they are vulnerable to occasional changes, and then they could really continue again, as we see here with the euro and pound, as basically both make a triangle formation after that, and then the euro dollar starts to fall a bit more than the pound dollar, so slight gap as well. So if you're looking, if you find it interesting to look at correlations, one way of doing that is taking a look at Admiral Markets MetaTrader 4 Supreme Edition, where you can find it as part of basically of the indicators that you will have in your list when you open MT4. You just need to basically add it to the chart, and you'll have these boxes. You can have, well, typically you have one box, but I'm showing two. You can change how many bars you look at. So the correlation is, in this case, valid for 200 days because I'm looking at the daily. But you can change the daily too. You can change it to a weekly, 1 hour, a 4 hour. That's all up to you. You can also show every correlation or highlight the strong or medium correlations. That way, basically, you filter out the weak ones, right? So here we don't see blue and green, which are the weak and medium ones, but only the orange and red, which are the strong correlations. So when you filter it out, you kind of keep the ones that have the stronger correlations. You can do it the other way around too. You can only focus on the medium and weak ones. All right. So that's how you can filter it out, so you can focus on the ones that are most interesting for you. So here, for instance, on the euro dollar, you can see there's a strong correlation with dollar Swissy. With the dollar yen, there's strong pound dollar and New Zealand dollar and euro yen and euro pound and pound odd correlation. And mediums with these three. Weak one with the euro Swissy. The dollar CAD has no correlation with the pound, nor does it have any correlation with the euro Swissy. It has a weak with the euro yen, euro pound, and pound odd. So that's how you read it, basically. All right, that's useful. You also have a correlation trader with Admiral Markets. Basically, you can see on various time frames, like this is the daily. Here on the right is the hourly, what the correlation is between pound and euro, and you see the charts as well. You can see that, yeah, it does look very similar. Up, down, up, right? Same pattern here. But on the hourly, well, here we had some upside. Here we went flat. Here we had up. Here we had flat. So no wonder that the correlation is indeed lower. All right. What is going on right now, Emre is asking. Well, let's take a look. We can, it's a good question. We can add live charts here. And you would find the correlation trader, by the way. When you have access to MetaTrader 4 Supreme Edition, you just see it right here in strategy. You will find Admiral Markets correlation trader, correlation matrix, alarm manager, mini terminal, etc. All right, so euro dollar, in my opinion, bearish because of the break of the trend line. But I was open for retracement of this swing high, swing low back to a deeper fib. Now it only went up to the 38.2, but I think it could go deeper to the 50 or the 61.8 fib or even the 78.6 fib before turning back down. So that would not surprise me personally. But if it breaks through 109.80, then we are getting into bearish territory. And I saw a analysis from Nenet also referring to 110 being an important level for the bears. So that's basically we are agreement 109.80, 110, very important because otherwise, we might not get that downside. We need to break that. Otherwise, we could still be in a balancing spot up to resistance, and then we could see a turnaround. There are a couple of things I think that are good. We got a trend line here. We have a break, so this could be a hook back for more downside. Obviously, if we break through this top, then this bearishness is invalidated. Pound USD. All right, pound USD. Well, basically, a bearish too, but I must admit that I think it's an interesting spot because if it is, basically it's retracing here too, hit the 50 fib, and it could go deeper before it turns around. But from a wave perspective, I wouldn't be surprised if this is a bigger correction as well. So I'm very interested how price will respect the 78.6 fib. Is it going to fall a lot and break this support level? Well, then we're in a downtrend. If it basically turns around at the 78.6 fib and starts to climb again, we're in a bigger upside zigzag. So for the moment, I would be interested in shorting the pound at 133.20, 133.90, where we have 61 and 78.6 fibs, even the 880.6 fib. I think that's an entire resistance zone, good for shorts. But how far will price fall? And honestly, I think it's 50-50. I'm not going to give any preference here. Split right down the middle in my view. It could be both. It could be a small bounce. It could be a huge move down and a break of this trend line and a big fall. I'm cautious with this as I think that both scenarios could unfold. You see, we have basically price making downside here, but we had a strong push up as well. And if you look at let's see, where's my fib? There we go. If we look at this fib, then we see the price also respected this 61.8. We talked about it on Wednesday, the potential bounce here, and I said 5 to 6 candles not breaking this bottom is the buy signal I'm looking for. 1, 2, 3, 4, 5. This was the 6th candle. So anyone who took the buy there on the inverted head and shoulders pattern as well got some good pips up to the 50 fib that we were talking about. We talked also about the zigzag pattern. So perhaps some of you took that trade. That's great. That was some good trading there from the pound USD upside. And we talked about downside on Tuesday. So pound trading went very well on Tuesday, Wednesday, downside, upside, back to back. Now, I wouldn't be surprised maybe to see some small corrections still, but ultimately a bigger head and shoulders, inverted head and shoulders, for one more push up to those deeper fibs we just talked about. Then see a bounce, and then I'm curious if we get a big fall or do we get a bigger upside again. I don't want to speculate too far at that point because we're talking so far ahead. All right. Let's see. This was basically a slide I wanted to talk about in the sense that I already actually talked about a bit about it just a while ago, basically showing which stocks are doing better throughout economic and the stock market cycle. All right. So, the economic cycle is a bit behind the stock market cycle. So you would see the stock market rising a bit and the economy typically following a bit later. Well, the last 10 years, that particular cycle, that typical reaction, not as strong as it used to be because the economy is not picking up and a rebounding after the recession as strong as it typically the last 30 years has. The economic recovery has been mild the last 7 years, has been slow, and we see interest rates still at historical lows. So this is a bit different environment than the last perhaps 30 to 50 years, right? So that's another thing that has changed, another breakdown that we are used to. All right, but typically you'll see, of course, some stocks move at certain stages of economy together as the economic and stock market cycle move forward and lower. Here you can see which stocks do better. For instance, transportation, when the economy looks weak, when the economy looks basically better, we see that other stocks start to do better. All right, so this is a standard business cycle. It says 4 years. So if we're in late expansion, energy, basic materials. If we're in early contraction, financials, utilities, consumer cycles like food, for instance, or your typical groceries that you do, is good for late contraction. Here's what you would expect from the markets. Stock prices to rise, commodity prices to rise, inflation rises, and you get basically the opposite again. All right, so if you want to take a screenshot, this is a pretty handy overview of what we generally expect, the correlations we expect to unfold depending on the cycle that we see. The Forex market also has a cycle. We see basically momentum and correction. Now at this stage, well, that's a good question. I think we see various points depending on what part of the world we're looking at. I would say that emerging markets are struggling at this point. So we might be in a late contraction. It's a bit difficult to say at this point, I would say. It's because it's not following a classical standard business cycle 4 years. We've seen substantial correction and consolidation after an enormous dip in 2008 and 9, going sideways. So I think that's a bit difficult to say. We probably had some expansion in the US throughout those years, a mild one because the interest rate hardly even budged. Only last year did it move up a quarter. So that was one of the mildest waves of an expansion you probably can imagine, I guess. And now it's contracting a bit, I think, partly because of the world economy that is just going very slow. Europe, China is struggling, emerging markets is struggling. So I think it's a difficult question to answer because kind of this lost its rhythm in 2008. But yeah, in the US, I would say it's looking more like a potential expansion phase where, difficult to say, and we're looking more at contraction in Europe and emerging markets. But yeah, it's a tough one. Now, market cycles, basically we see impulse and correction. Those are also typical cycles. And we see basically trend and reversals as well. So that's something that, when we see impulse and we see a correction on the other pair, for instance, that would indicate that they're not correlated. If we see momentum in the opposite direction, that's negative correlation. If we see the momentum in the same direction, that's positive correlation. That's how we could basically measure that with Forex market. We can measure that very easily with moving averages. When price is expanding, moving away from those moving averages, that's momentum. And if price is hanging in the moving averages or bouncing back and forth from it, that would be basically a consolidation. All right. So that was very quick because my time is running out. But this is how moving averages, I think, give a great way of understanding impulse, understanding momentum, and correction as well. So you could basically take a couple of currency pairs, use moving averages, and compare them like this, right? But this is, well, these windows are a bit too small, but you would want to have less currency pairs open. But you can use this button and compare, 9 of them, and you can look at how the price is reacting to those moving averages, and you'll see a very quick overview of how those pairs are looking like. Let's add some moving averages quickly. All right, so this is how the Swiss yen is looking. Oh. Let's take a look at the dollar yen with the same moving averages. And looking pretty much the same, if you remember. Moving averages crossing over the long term. So you can see pretty much, when they are aligned or not. Now, you don't have to do that necessarily because you got the correlation matrix, right, as well. So, but in general, I think that the moving averages are a great tool for support and resistance, for measuring momentum, for looking for breakouts, for understanding trend. They have great value. So I'm a big fan, and I think that they also help with understanding correlation. Nathan, for instance, says, look at Euro odd versus odd Swiss, highly correlated, and makes sense because Euro and Swissy typically are correlated, and we see it in the matrix actually, right here, that they are correlated. Euro dollar, dollar Swissy, highly correlated. All right, so Nenad is going to hold on because Nenad is going to dive into a lot of good and interesting correlations. So I'm looking forward to that. So let me pass over the microphone to Nenad. Let's see if I can reach him.
Thanks, Chris, and hello, guys. So yeah, I have noticed some questions while Chris was talking, and some questions were actually referring to me. And I see Emre was asking, what about euro dollar? Emre, the thing is about the signals. We cannot provide the signals. We teach you actually what to do, but if you read our analysis and if you pay attention to what we write, basically that is how you can also trade, because the analysis is not just simple analysis that gives you the levels. For example, if you take a look at this one, this was the analysis I did yesterday, and here the exact thing, it was POC. So if we see a jump on POC, you should actually short it because this is the spot to go down. And additionally, I wrote a retest of 1030 could be good for short-term sell setups. And if you follow these advices, simply in euro dollar, you could have made like, I don't know, 50, 60 pips easily. So there are no clear signals, but the point here is to teach you how to trade, and by reading this and applying this, you can actually use it for your own trading, okay? So just pay attention to our analytical side. Here is technical analysis, here is Chris' excellent wave analysis, and you will be fine, okay? Now, as for correlation, guys, I will focus on some commodities and equities. Of course, I primarily trade Forex, but the thing is I always watch mostly for equities. I'm not a commodity trader, although a lot of people have been asking me to actually do some gold setups and maybe eventually oil. But the thing is, yeah, that is what I plan to do in the future. But right now, there is good correlation between some of the Forex pairs and both gold and oil. And as Chris said, it's very easily accessible by using correlation matrix. And with correlation matrix, you can see correlations. You can see correlations very, very clear. So you don't need to actually use other websites for correlation. Now, because we also have some new people always on webinars, I will just explain what is base versus quote currency. So when we say pairs, we think about base and quote currency. Base currency is a basis for transaction. So if you buy, the exchange rate shows how much units of the quote currency you should pay for a unit of the base currency. If you sell, it's actually vice versa. Now, buy when you think that the base currency will appreciate, and sell when you think that the base currency will depreciate. So if you watch euro-dollar, euro is base currency, dollar is quote currency. Now, all dollar pairs are very, very correlated to dollar index, guys. Okay, so if you watch dollar index, then you will probably observe what other dollar pairs do. Sometimes you will see that the dollar is base currency and the opposite currency, like Swissy, is quote currency. Okay, and quotes always have two ISO designations. So remember that. Okay, now commodities, what I pay attention to, and I might do some analysis in the future, is oil and gold. Of course, I know much about silver. Palladium I don't follow that much, but the thing is, gold moves and oil moves also. Silver is not that great of a mover. Mostly it's a ranging commodity. Now, let's say that you ask me how oil affects dollar CAD. Well, the simple question is, well, gold is, we can say it's also safe haven, okay? But the thing is, Canada is also one of the top oil producers in the world. That is also very important to know. Okay? Now, oil is the major source of energy. Okay? Now, Canada exports oil to United States. Now just think. If United States is based on dollar and Canada is based on oil, when Canada exports to United States, that makes it, of course, the biggest supplier of oil to the USA. It means that Canada deals oil to United States, okay? Because of the sheer volume involved in those transactions, it will create a huge amount for Canadian dollars. That is why dollar CAD and oil are simply negatively correlated. I mean, when dollar CAD is going up, oil is going down. Okay? Now, pay attention to Canada, because the thing is, dollar CAD is always affected to changes in oil price. Okay? If demand in oil drops, it will hurt demand for the CAD. Okay? So dollar CAD and oil are negatively correlated. Okay? CAD up, oil up. Dollar CAD down, oil up, and so on. So that is why I try to explain you base and quote currency. Because guys, you cannot just say CAD and oil, because you have dollar here, guys. Where dollar is base currency and CAD is quote currency. So when you say CAD versus oil, we need to think about dollar CAD versus oil. Okay, because we trade dollar CAD, we don't trade CAD. You need to have two currencies, base and quote currency. Now here is the example of dollar CAD, and you can see WTI and dollar CAD complete negative correlation. You can check easily in correlation matrix. Okay, so just click on correlation matrix, and here, let's say 4-hour last 200 bars, it equals to last 200 bars on 4-hour time frame. You can see WTI and of course Brent. It's well, correlation normally is most positive, but dollar CAD, you see minus 82, guys, minus 82. Okay, well, huge negative correlation, and that will probably always remain the same. Demand in oil fall, and then it will hurt demand for the CAD and vice versa for supply. Okay, so dollar CAD minus 82, and here you can easily see it on the chart. It goes down while dollar CAD is going up, and this can be very, very interesting to watch the correlation between those pairs, because if you see, this is support here on WTI, and this is resistance. So it will take a huge momentum push to break this one. Because of that, you might opt to actually exit the trade when it comes to resistance, and because this is correlation also on WTI. So pay attention to those commodities and Forex pairs, because they will move, guys. They will move a lot. Okay, you see here I have ATR indicator. It says 52 ATR for dollar CAD, and the last 7 days is 106. Well, simply put, there is not a big movement today, guys. There was not a big movement in oil today. Because of that, dollar CAD was mostly ranging. We didn't see a huge movement. And actually, I tried to trade dollar CAD in the morning. I tried to trade it with my ECU, with our ECU system. And what I did, actually, I recorded a video for other pair. But dollar CAD, I closed it. I actually started to record a video, and I closed it after 7-8 pips. Well, it really wasn't worth of recording the video. 7-8 pips, guys. And yeah, frozen screen. Sorry, guys. Here. Do you see now the screen? I didn't see messages. Okay, see now, guys. WTI down, dollar CAD up. Okay. And the point is, what I was trying to say, and I will go through this again, no problem. When I recorded a trade, I was really thinking that it could go more to the upside. But when I paid attention to WTI, so this was something like a ranging price action, especially in lower time frames. So I closed the trade for a mere 7-8 pips, and I moved to other pair. So the thing is, watch for this. It's important. And this is what I was trying to explain. Correlation matrix. On the correlation matrix, you can see WTI, dollar CAD, minus 82. Same with Brent, actually crude. So the thing is, everything is the same here, guys. Correlation is the same. Okay? So the point is, crude oil or WTI, I watch WTI most of the time. It will move negatively with dollar CAD. And as I said in this slide, you need to watch base versus quote currency. So if you see dollar here and CAD here, know that dollar is base currency and CAD is quote currency. Because of that, you cannot simply say, okay, I will trade just CAD. No, it's not just CAD. It's base currency also, so dollar CAD, okay? And use the excellent tool named correlation matrix. It will help you really trade efficiently, okay? So you see the correlation. Now, a next correlation, there is strong correlation between Australian dollar and gold, guys, also. Now, why there is correlation between Australian dollar and gold? Okay, well, there is historical relationship between price of gold bullion and Australian dollar. Okay, the point is that the rise of the Australian dollar has eliminated much of the benefit of the rising value of gold, and gold is priced in US dollars. Okay, and strong correlation between the pair and the commodity can impact unhedged gold exposures. Okay, so the thing is, gold is regarded as a commodity, but also as a safe haven currency in its own right. When you see dollar weakness, you will usually see gold increase in value, because investors will flee from dollars and they will choose to own gold. Okay, of course, Australian dollar will also strengthen when dollar is weak. So pay attention, guys, also to dollar index, to Australian dollar and gold, because when dollar index is weak, Australian dollar should rise along with gold. Okay, don't forget that Australia is largest exporter of gold. It's a major producer of gold and other commodities, including iron ore also. So Australian dollar is commodity currency. Okay, now if we open our chart again, well, guys, this is new, something new. This is a mini chart. It's part of new Admiral Market Supreme, and I will make a webinar about new Admiral Market Supreme edition next month. So you see 4-hour gold and also watch 4-hour on. Look at this, guys, almost the same pattern here. Do you see this? You see, this is a rounded bottom here, like it looks like W-shaped reversal, but it also can look like inverted head and shoulders. And watch this, Australian dollar. Completely the same. Okay? Completely the same. Now, what's the point in this, guys? And now Emre is asking, can we know which one is earlier, can give us better trade? What I do, guys, now pay attention. This is good advice. Let's say that we want to trade Australian dollar and we watch gold. Now, if you see that gold is moving, but Australian dollar is not moving, and you have a buy signal for Australian dollar, what would you do? Of course, you would open a buy trade. Because sometimes gold can move earlier than Australian dollar. Okay, you will buy gold, Emre, but you can also buy Australian dollar. Because if gold is already up and Australian dollar is currently sitting, it's trying to go up, but it doesn't go up, and you have a buy signal, that means that you will be buying Australian dollar at a better price than gold. Sometimes you will notice, guys, that equities or commodities move earlier before currency pairs. Use that information to trade Forex pairs. Okay? So if gold starts to move up, Australian dollar is currently going over, and you have buy signal, go long on Australian dollar. Same for dollar CAD. If you see that WTI is going down, okay, but dollar CAD is still supported, you might want to actually buy dollar CAD. And the table is here. It's found in Admiral Market Supreme Edition. When you install Admiral Market Supreme Edition, you just need to use correlation matrix. Okay, that is why trading with other markets is really much easier. Guys, you have all these tools at your disposal. Now I will move on to equities. So guys, pay attention to this. If you see that oil is moving, dollar CAD is doing nothing, well, you might go in a trade. Oil down, dollar CAD should go up very soon, and vice versa. You might want to trade oil if, let's say, dollar CAD is moving, but usually commodities will move first and Forex will follow. Now, equities. Equity market is very closely covered in news, TV, and media. I personally don't call indices, I call it equities, okay? Because equities is group of indices and we call it equities. So you invest in companies that make everyday products. Equities move a lot. It's well known that most of the strongest equities will move much stronger than Forex pairs. Sometimes you will see DAX moving 300-400 pips, while, let's say, euro-dollar moves only 100 pips. Local currency is needed in order to purchase stocks from a particular country. So if you want to buy dollar stocks, you need to exchange your local currency into dollars. And that means outlook for a certain stock market is good, international money flows in. Outlook for a certain stock market is bad, international money flows out. Generally, strong stock market equals to strong currency and vice versa. Okay? If you see, let's say, that, and this is important, now I will explain why I mean this. Strong stock market or equities, okay? Strong currency and vice versa. That is very much reflected on yen pairs, guys. Very much. Now, these are most well-known equities. Dow US, Nasdaq, largest screen-based equity securities trading market, Nikkei, Japan, DAX, Germany, SP 500 US, FTSE, highly capitalized UK companies, DJ, Euro Stocks 50 blue chip index, China A50, ASX 200 Australia. Okay. So the point is, guys, out of all these equities here, I watch these. This is my favorite. Not just ORIEN. ORIEN is my favorite pair. But also I need to add Dragon, pound yen. If you notice recently, I've been publishing pound yen analysis more often. Pound yen is one of the pairs that also goes very, very good along with equities. ORIEN is, and now pound yen are my most favorable pairs when I trade yen. Both ORIEN and pound yen have a high correlation with ASX, DAX, SP 500 and Nikkei, guys. Okay? Now, why is that correlation? Of course, guys, that is because yen is also watched as a reserve currency. When it's risk on environment, okay, when you see that it's risk on environment, GPU will depreciate. When it's risk off environment, usually the opposite occurs, and as a result, GPY appreciates as foreign flows from Japan are repatriated back to their local currency. So if we take a look at pound yen, for example, okay, see pound yen 4-hour chart. And let's take a look now at Nikkei, that is Japanese 225. Let's say if I can put it like this, Japanese 225. That is Nikkei. Let's see if here, guys, you see correlation. Okay, So correlation is very strong. I will do it like this. Okay, correlation is strong. Now, if you open correlation matrix, you will also find it here. You need to add both GBPN, here it is, and we will add, yeah, we have it, Japanese 225, and watch correlation now. Plus 51 on 4 hour, and on daily, guys, intraday charts, plus 93. Wow. Well, what does it mean, guys? During the Asian session, when Nikkei works the most, you will see pound yen movement. And guys, that is the time to trade the dragon. Ride the dragon and ride it successfully. Because if you see that Nikkei starts to drop, pound yen will probably start to drop soon. So that might be a good time to short into dragon. Today when I saw pound, there was some bad news for pound. DAX was starting to go down, but pound yen didn't go down. After a couple of minutes, I saw that pound yen dropped 30-40 pips in a second. So that means, guys, that if you were following DAX during London session, you could have seen that actually dollar yen followed. And look at this, 4 hour, let's say 100 bars, last 71, guys, correlation between pound yen and DAX. Because, guys, yen pairs follow equities. Okay, yen pairs follow equities. The underlying asset in the index is equities. Okay, so follow it, guys, follow it. Okay, when you see indices or equities going and forex pairs stalling, be prepared to go in that direction of equities direction. Okay, it's very important to know this correlation. Same for ODN, guys. Watch this. ODN and pound yen, 85 correlation. It means they move in the same manner, right? Watch this. ODN, SP 500. ODN and SP 500 is plus 89. Now, ODN, let's say, and DAX, 93. Now, we can use correlation on, let's say, last 200, 300 bars. Okay, there you will see when this loads up, you will see that ODN also has strong correlation with Nikkei index, guys. Okay, you will see that very strong correlation. So you see correlation between yen and equities. Now that translates into this. Okay, that translates into this. Wait, let me find it. ODN, pound yen. I trade most of those two pairs. Can be traded by watching ASX, DAX, SP 500 and Japanese 225, that is Nikkei. During the morning, guys, during London session, watch for DAX and yen pairs. Okay? During New York session, watch for, let's say, SP 500 and correlation between yen pairs. It's not that strong, but watch it. And also during Tokyo session, watch for Nikkei and ASX 200, because you will find also strong correlation between those two markets. I mostly focus, guys, on Nikkei, because lately I will show you now H1 correlation, ODN and ASX 200. You see here, it's good, 73. It's not that bad. But if you compare it to actually other markets such as SP 500, you will see that SP 500 is stronger. So during London, you watch DAX and odd yen and pound yen. During New York, you watch SP 500, odd yen and pound yen. And during Asia session, you watch Nikkei or ASX and odd yen and pound yen. And those correlation will give you the cues and possibly early bird entries. Because, as I said, when an equity starts to rise and Forex pair is stalling, that means that usually Forex pair will follow soon. So that means you will get a much better price to trade it. Okay? So guys, if you have any questions, feel free to ask me. As always, tomorrow expect new analysis. I will come up with new analysis. Okay, we had some movement on euro dollar, and actually it was sell-on rallies. And thank you everyone for your answers. I did some tweets about it, guys, and I have a poll here. And actually, the answer was sell-on rallies, and sell-on rallies, we were correct. Okay, so thanks all for answering. I will send it now, guys, and thank you again. When you see that Chris and I made polls, just feel free to actually use this poll. You see everything is live, and that went perfectly with our analysis here, guys. When you watch this, you will see that I actually sell-on rallies that looked like yesterday. So, okay, that was it. I hope that you will use this information. It will greatly help you, and we hope that you will make good pips with trading not just dollar pairs, but also yen pairs. No questions. Thank you for listening. And we will be, of course, here with you soon. And we wish you to trade safe. Tomorrow is a profit-taking day. Be careful. And as always, guys, trade safe. Cheers, everyone.